Hello and welcome to the Retirement and Money Show. So in this video, we're going to look at the investment mistakes that can cause an issue for you in your retirement. See, most people work for 40 years to build up their pension pot, but then they make simple investment mistakes that ultimately can end up wrecking it. And the crazy thing is that these mistakes are completely avoidable. So in this video, I'm going to cover what I think are the 5 biggest blunders. First, I'll show you why keeping everything in cash actually kills your pension. Then we'll look at the opposite problem with taking too much risk. After that, I'll explain sequencing risk and why it matters so much. Next, I'll show you the withdrawal mistakes that actually drain your pension really fast. And at the end, we'll cover the investment pathways and why you need them. By the end of the video, you'll know exactly how to invest your pension safely. You'll understand which risks to avoid and which ones to take. Plus, I'll also reveal the one tiny mistake that I think ultimately destroys your retirement income. So my name's Sak Hussain and I run financialeducation.co.uk and I've got over 25 years experience of helping people plan for their retirement. So the cash trap. This to me is mistake number 1, and unfortunately it's actually really common. Thing is, people retire and they panic about losing money in the stock market. So what they do is they move everything into cash, thinking that's the safest place to put it. But the reality is cash is not safe in retirement at all, actually, apart from in very small proportions generally. And that's because inflation eats away at your money every single year over time. So let's say you've got £200,000 and you leave it all in cash. With 3% inflation, that buying power drops to £170,000 in just 5 years. So that's £30,000 of value gone completely, and unfortunately it never really comes back. Now the state pension is currently around £12,000 a year for most people, so that's your base level, but it won't cover everything you need in retirement. And if your pension is sitting in cash, the reality is it's actually shrinking because you need some growth to keep pace with rising living costs. Now, this doesn't mean putting everything into risky stocks. Obviously, you do need some investments that can grow over time. And there's research out there that shows retirees who 30 years ahead need growth exposure. So even at 65, your money might need to last until maybe 95. So that's 3 decades where inflation will keep eating away at everything. And this is the danger of being too conservative in your pension investments. But there's an equally dangerous mistake on the other side too, and we'll cover that on the next slide. So moving on from cash, let's talk about what I think is the opposite mistake, and that is taking too much risk. So this one catches people out because the timing is what destroys pension, and it's called sequencing risk, and it's absolutely critical to understand properly. So here's how it works in really simple terms. So imagine you retire with £500,000 and you're taking £25,000 out yearly. So if the market drops 20% in the first year, that's going to be devastating because all of a sudden your £500,000 becomes £400,000, but you still need that £25,000 of income. So what happens is now you're taking money from a smaller pot and that's already fallen in value. And this means you're selling investments when they're cheap and locked in. And that makes it really hard for your pension to recover. You see, 2 people can have the exact same average returns over time. But if one gets bad markets early on, they could run out of money a lot quicker. And the other person with good early returns ends up perfectly fine throughout their retirement. So this is why the order of returns matters so much, unfortunately. And that's because you need protection against this sequencing risk in the early retirement years. So most experts suggest keeping 2 to 3 years of spending in safer investments. So if you've got an ISA, for example, that's what you could use. And that way you're not forced to sell stocks during market crashes. You can also wait for markets to recover before touching the growth investment. But here's where the next big mistake comes into play, and I'll cover that on the next slide. So we've talked about cash traps and sequencing risk. But most people don't have any proper investment strategy at all. And that's the big risk that I find when I talk to people. So this is where investment pathways come in to help you. See, the FCA, or the Financial Conduct Authority, which is a regulatory body that looks after pensions in the UK, created 4 simple investment pathway options for pension drawdown. And drawdown is what most people take in retirement if they don't take an annuity. And drawdown is effectively like taking money and drawing money down from your pension like you would taking money out of a bank account. And these are all designed to match what you might want to do next. So option 1 is for people not touching money for 5 years. Option 2 is for buying an annuity within the 5 years ahead. Option 3 is for taking a long-term income very soon. Option 4 is for taking all your money within 5 years. So each of these pathways invest your pension differently based on your actual timeline in retirement. So this stops you putting everything in the wrong type of investment from day one. The problem is though, about 1/3 of people don't even know where their money is invested, and that always surprises me when I ask them. What happens is they just took their tax-free cash, got excited with it, but left the rest sitting there. So the pension sits in whatever default option their provider chose, and that can be really random. And that default might actually be completely wrong for their actual retirement plans. And this mismatch can actually cost you tens of thousands of pounds over your retirement life. So what I recommended you is you actively choose the right investment pathway for yourself, or you need to build your own strategy, hopefully taking some proper advice. But what you absolutely cannot do is just ignore this decision and hope for the best, because the reality is the outcome is likely to be not the best. So we've covered some of the key risks and key things that you do need to think about. But on this next slide, let's just get practical about what you actually need to do next. So the first thing you need to do is check where your pension is invested, and I recommend you do that right away. You can do this by logging into your pension provider's account and look at where the actual investments are held. Is it sitting in cash, or is it actually invested properly? If you're already in drawdown, check which investment pathway you're currently using and think about whether that pathway matches what you actually plan to do with your money through retirement. After that, what I recommend you do is you think about your timeline and think about this very carefully. Think about when will you need this money and how much you're likely to need each year. That allows you to work out what your must-have spending is and what your nice-to-have spending amounts are. This will ultimately tell you how much needs to be in safe investment. It'll also help you think about how much can stay invested for longer-term growth. What I also recommend you do is you create a cash buffer of 2 to 3 years worth of spending money. And what I think you should do is keep that in an easy access account or short-term bonds for safety. Although over the past few years, bonds haven't been as safe as they have been in the past, so you do need to think about this too. But ultimately, what this should do is should protect you from sequencing risk if markets drop badly in your early years of retirement. And the rest of it, well, they can go into growth investments like stocks and shares. But what you should do is make sure you review this strategy every year to make sure that it's still working for you. And if you're not confident about any of this, I recommend you get proper financial advice, because a financial advisor can help model different scenarios and stress test your strategy. So for our final slide, let's quickly recap the 5 big investments mistakes that you want to try and avoid. So mistake number 1 is the cash trap. And just remember, this is where people keep everything too defensive in how their money is invested. This feels safe, but inflation destroys your buying power over time. Mistake number 2, well, that's taking too much risk when you can't recover. Now you do need some growth, but you also need protection from losses. Mistake number 3, well, that's ignoring sequencing risk completely, which hopefully, as I've outlined earlier on, is actually really dangerous, because bad markets early in retirement and big market falls can wreck your pension for good. Mistake number 4 is withdrawing too much too soon from your pension pot. And this is because it leaves you exposed if markets fall and you run out of money. And the final mistake, number 5, is not understanding your investment pathways or having a strategy for your investments. See, most people just leave money wherever it lands when they retire, and that's usually in some sort of default fund. The key point is pension investment in retirement needs proper planning. And what you need is a good balance between growth and protection, both at the same time. And I also recommend you give yourself a cash buffer to avoid selling in market crashes. And ultimately, what you also need to do is you need to match your investments to your actual timeline. So get this right, and your pension can last you 30 years through your retirement comfortably. But unfortunately, if you get it wrong, you might run out of money much sooner than you would have liked. So I hope you found this video useful. If you did, please do like it and do subscribe to the channel. We do have lots of other videos related to retirement planning. And finally, good luck and goodbye.